Good evening, friends. This is Ramkumar here. I brought you this sixth episode of my executive series. I am a veteran in capital market, having over 30 years of service. Brief. This is my brief introduction. The full introduction is available later in the presentation. We will talk here about the types of securities that are there available in the market for an investor to choose from and invest in. Since the number of securities or types of securities are huge in number, we will not be able to cover everything in one episode. So we'll have multiple episodes covering all types of securities. In this part or part one of this types of securities episode, we will speak exclusively about the types of companies that can issue securities as well as the types of shares, that is equity shares and preference shares. Now, since this is an educative series, we wouldn't expect you to be, we wouldn't expect you to be treating this as an advice to invest or not invest in shares or securities of any type. So a disclaimer to that extent is available here. We would request that you read it in leisure later. Now, there will be many questions that a investor or a would-be investor would be having in terms of what is the share market that people speak about, and is securities same as shares? Typically, the securities include each and every type of instrument that is issued by a company or that can be issued by a company, which ranges from equity shares to bonds to debentures to money market instruments to other more exotic type of instruments. We will try to see each of them one by one. The question that an investor would have is, what are the types of securities? Why should the company be issuing so many types of securities when one type of security is good enough? When will the company issue these shares, and when will I come to know that such shares or securities have been issued? Where do I get to buy these securities? Who is the one who decides on what type of security should be issued? And last but not the least is, how are these securities issued? Now, as I mentioned earlier, there are various security types. We have got shares, which is the most talked about in the market. Second type of this thing is the debt. Debts are generally either called bonds or debentures. Then third broader type is money market instruments. The fourth type is all other types of instruments, which includes GDR, that is Global Depository Receipt, ADR, there is American Depository Receipt. Then there are many other types of securities which we will see as we go along. Are all shares the same? No. Basically, there are four types of shares. The equity, which is the most talked about. Second is preference shares, which is issued by each and every company, almost each and every company which comes out as an IPO. In case somebody doesn't know about IPO or wants to know about IPO, there is a series of mine, which is actually the second in the executive series. So you may want to look up the presentation or the episode on IPO. Please do so. The third and fourth types are types of shares which are not issued as much in India. So we will, although mention that, we will not really be speaking about it in detail. One is treasury shares, another is redeemable shares. Which are the types of companies which usually issue shares or which can issue shares? We will start from the base in terms of proprietorship company, proprietorship firm. It's not a company, it's a firm. Proprietorship firm is basically a one-man show, in the sense that it is a proprietor who manages the shop or the firm. These entities do not have any kind of shares issued. So they are out of the ambit of our overall discussion. But a step up of this sole proprietorship is an one-person company. This one-person company is a company which, as per the Companies Act, will have one owner. So all the shares will be issued to him. So it's something where the shares are issued, a company where the shares are issued. The third type can be a partnership firm. Partnership firm typically have multiple partners, two or more. Each of these partners, based on the partnership deed so entered into by them, will be responsible for that much of assets or liabilities in terms of the partnership firm. A step up of the partnership firm again cannot issue any shares, it is all based on the agreement that they enter into. And it terminates automatically unless otherwise specified in the agreement on the death or one or more partners. A step up of the partnership firm is a LLP, that is Limited Liability Partnership. This is blessed by the Companies Act in terms of this being able to issue shares. So this becomes a partnership firm with a limited liability. That means each partner will have liability limited to the number of shares taken up by him from the LLP. The third type, which is the most important or the most talked about, is a company or a corporate or a corporation, as some people like to call it. These companies are the ones which issue the shares. There are two types of shares issued by these companies. One is unlisted. That means it is held by a closed group of people, maybe the promoters and the group of promoters, people who know the promoters, etc. The second type is a listed share. Listed shares are those shares which are issued by the company and it is available in the BSE or NSE platform for buying or selling. This is what generally you speak about when you say shares are available in the market, share has gone up, share has gone down, etc. That is this type of shares that we talk about. Third type is a not-for-profit company. Not-for-profit company is a Section 8 company. Section 8 of the Companies Act really talks about this not-for-profit, but basically these companies only work for the objective for which it has been set up. They don't work for profits. In fact, profits, if any generated, would be returned back to the investors as dividend, or it will be held back by the company for further progress. There are other types, but we will just skim through in terms of saying that there is some company called limited by guarantee. Here also the shares can be issued and it is guaranteed by the shareholders who take up the initial shares of the company. Now there will be certain issues in terms of rankling in the mind of the shareholder, as when they read the newspapers they will suddenly find some place where somebody talks about book value, market value, face value. What are these? We will see. Face value is the value at which the shares have been recorded in the books of the company. So typically it will be a 10 rupee share or a 2 rupee share or a 5 rupee share. If you look at it, for example, a Tata Steel shares is a 10 rupee share, so face value is 10. A Reliance Industry share is a 10 rupee share, so face value is rupees 10. There could be other companies with face value 2 and 1 and others. In India, as we speak, the share value or the face value of the shares can range from 1, that is a proper integer, to 10, that is again a proper integer. Shares with face value less than 1 or in decimals is currently not allowed. And typically we will find shares with face value 1 or 2 or 5 or 10. You do not generally find shares that has face value which is odd, in the sense 6 or 7 or 8 or any other number. As we speak, we will find out. Next is the market value. Market value is nothing but the share price available in the BSE or NSE platform for a share. So for example, if you see the shares of say BSE or CDSL or Tata Steel, let's take Tata Steel as an example. The market value of Tata Steel would be 167 rupees or 165 rupees. So that is the market value. This is very different from the face value, which is 10 rupees, as I mentioned earlier. So the market value will always be equal to or higher than the face value, or sometimes even lower, depending on the profitability of the firm or the company and the future prospects of the company. The market value is affected by various factors like what are the past results, what will be the results in future, what are the economic scenarios that the company is going into, what are the tariffs that will be applicable to the company in the country where they are selling or buying, selling their products or buying their raw materials from, etc. etc. Third is the book value. The book value is nothing but the difference between the assets and liabilities for a particular company. So if you want to know the book value per share, then you just divide this number that you receive after getting the difference between asset and liability, divided by the number of shares issued by the company, then you get the book value per share. This is typically lesser than the market value because the market is always future looking, while the book value is based on the facts that is already available in the market. So you will find book value being lesser than the market value most often than not. Very rarely you will find the book value higher than the face value, higher than the market value, provided the future prospects of the company looks grim at that point in time when you saw. There are many other types of values, but we will just look through at one value which says par value. Par value is nothing but face value, and the par value is always the same. So a company, when it is issues shares, if it says the shares are issued at par value, that means the face value and the par value is the same, and the shares are issued at the same cost as is mentioned in the face value. If the company says that they are going to issue shares at a discount, that means the face value or the par value is higher than the price at which you got the shares. If the company says it is going to issue the shares at a premium, which is what is the case with most of the IPOs that you see in the market today, then the premium is nothing but the value over the face value that you pay to get the shares of the company. We look at the types of shares that are available in the market for sale or for purchase. The most well-known or easily known type of share is a fully paid up share. Fully paid up share means the face value is fully paid up to the extent of the face value by the investor. So these are shares which are typically available in the market. So if you say shares of Tata Steel or Reliance or any other company, they will all be fully paid up shares, as would be made available for you to see in the BSE or NSE website. Next would come as a partly paid up share. Partly paid up shares are those shares where the company is issued shares but not called for the full money, that is the face value. So let's say the face value is 10, the company comes up with additional shares and it says that you have to pay 2 rupees of the face value of 10. So then it is paid up to the extent of 2 rupees. So it's partly paid up shares. Now, partly paid up shares are shares where the value is ranging from more than 1 to less than the face value. More than 0 to less than the face value. Partly paid shares ultimately become fully paid up shares when the company calls for the remaining money, as and when they would want the money, or as and when the notice is issued by the company for calling for that additional money. Most probably, the company at the time of issuance of the shares itself say that the initial shares initial paid up value will be so much. At 6 months interval, we will call for the second call, and then another 6 months we will call for third call, and so on and so forth. So you can plan your payments in such a way that you will be able to have funds to make these partly paid up shares fully paid. Now there are various types of capitals that we should know about. Issuance of equity shares is not just issuance, but before that, a lot of work needs to be done by the company, more particularly the company secretary or the secretarial department. What is it that we need to do? The first is the authorized capital. Authorized capital of the company is the capital that is recorded with the register of companies, that is ROC, saying that these are the maximum shares that will be issued in terms of rupee value, in terms of number of shares multiplied by face value also. Now within this, all the shares that are issued, equity shares that are issued by the company will be within this authorized capital, either equal to or less than the authorized capital. The company issues shares, so that is called the issued capital. So suppose authorized capital is 100 and the company is decided to issue 90 shares, then 90 will be the issued capital. The third would be subscribed. Suppose out of these 90 shares which have been issued by the company, what is subscribed by the shareholders or the would-be shareholders is 87, then 87 would be the subscribed capital. Now suppose the company decides that they don't want to take the entire face value of 10 rupees. They want to only take little bit of money, let's say 7 rupees of this 10 rupees. Then the called up value of the shares will be 7 multiplied by number of shares, and not 10 multiplied by number of shares, which in our example came to 90. Then what is the paid up capital? Paid up capital is 7 multiplied by the total number of shares issued. Now somebody may wonder as to what is the difference between called up and paid up. Called up is when the company calls for the 7 rupees. Paid up is as and when the shareholder pays. So always it is possible that the called up capital is equal to or more than the paid up value, because all shareholders may not have paid on a given day the amount that is called by the company. The uncalled capital is the 3 rupees in our example. That is 10 out of the 10 rupees face value, 7 rupees has been called. 3 rupees is not yet been called, so that is uncalled capital. Last is the reserve capital. What is reserve capital? Typically, when the company starts running operations, they make profits over a period of time. So this is basically kept in account within in the balance sheet. It appears as reserve capital. So that is nothing but profits which are kept back by the company for further development or investments. Now we look at the types of preference shares. Broadly, the preference shares are issued mainly from the point of view of the promoters of the company. Typically, you will find that the preference shares are issued by the owners to themselves or their close group just before the company comes out with an IPO, mainly to handle the finances in terms of ensuring that their capital, their holdings do not go above the prescribed limit suggested or meant by SEBI. For example, the different types of preference capital are cumulative preference shares. The cumulative preference shares are where the dividend is paid at a regular interval, that is every year, at a specified dividend rate. If the company makes enough profit, you will get the fixed dividend rate. Non-cumulative is where, in case in a particular year the company does not make enough profit, they do not pay you the promised dividend. Say instead of 9%, they are able to pay you only 5%. So you'll have to be happy with 5% in non-cumulative. If it is cumulative, then you can expect the remaining, that is 4%, to be paid next year if the company makes profits. So this is essentially the difference between cumulative and non-cumulative. Participating and non-participating. Participating preference shares are where you will get more than your 9% promised if the company were to make more profit. Else you will get your 9%. Non-participating is where you will get only your 9%. You will not get more than that even if the company makes astronomical profit. Then you have redeemable and non-redeemable or irredeemable. Redeemable preference shares are where the company buys back those shares at a pre-specified date or time at a value specified again by the company in the initial offer document. Irredeemable are where it will run through the course and wait for the company to close down or the period to expire, preference shares period to expire. Convertible and non-convertible. Convertible preference shares are where the preference shares get converted to equity shares at a pre-specified date, which will be in future most of all the time. Non-convertible are preferences which will remain as preferences to the end of its period. Now we have run through the different types of companies, the types of shares, that is equity preference, and we hope that you have got the answers to your questions which we asked in the beginning as to what are the different types of shares. We saw 2 of them, remaining we'll see later. Why issue shares? Mainly to handle the cash flow. The company secretary and the CFO along with the managers to the issue decide as to which type of instrument is best suited for their cash flow and hence the balance sheet. When do they issue? They issue whenever they require extra money, depending on the requirement, depending on the balance sheet of the company, depending on the cash flow. They will decide the date or the time when the new securities have to be issued. Where will you be issuing these securities? If it is an unlisted one, you will be issuing securities to a closed group of people. If it is listed, then it will be issued and made available in the BSE and or NSE platform for trading, that is buying and selling. Who will be the one issuing these securities? It is a company which will be issuing, as we mentioned earlier. It will be CFO and CS who will be deciding on which type of instrument to issue, and then thereafter they will take requisite approvals from the board and then go ahead and do the issuance. How are the issuance is going to be? As we mentioned, if it is unlisted, it will just be issued by making entries in the books by seeking internal approvals. If it is listed, they will have to go through the process of filing application with SEBI, getting it approved by the stock exchange, etc. Now we will go for the interesting bit of trivia. The one may be wondering as to which is the oldest company that is that is known to us today. The oldest company is a Japanese company called Kongo Gumi. This is a company which is more than 1400 years old. This was basically into the temple building industry. This company got taken over by some other company in Japan by in 2006. So this is the oldest company in the world. As far as India is concerned, the oldest listed company is Bombay Burma Trading Corporation Limited. This is a Wadia Group company. Wadia Group itself was formed or created in 1738, one of the oldest group companies in India. And these shares of Bombay Burma were listed in 1863. So this is the oldest running company, listed company in India as we speak. Now my introduction, which you can read at leisure later. Should you find this video informative and educative, kindly pass it on to your friends and relatives. Please press on the like button and subscribe to this channel. You will typically find updates being put up on the link late in the evening every Sunday and Wednesday. Should you have any doubts or queries or suggestions, please reach out to me at ramkbharosay@gmail.com. The next educative episode on the types of securities, that is part 2, will be available soon. We would, or mostly on Sunday, we would like you to be present for that. Thanks a lot.